Your money moves at 1.1 times per year. Theirs moves at 40 times per year. That's not a typo. The Fed engineered a two-speed money system where every dollar you earn crawls through the economy, while every dollar they print flies through financial markets at light speed. The velocity gap is measurable, it's widening, and you can't escape it. Here's what should terrify you. Wage velocity collapsed 45% since 2000. Asset velocity increased 320% in the same period. The same central bank, the same currency, two completely different systems. One system is designed to preserve wealth, the other is designed to extract it. You're in the second system. And the math says the trap is already closing. You'll see the exact mechanism, the historical blueprint that's played out 3 times before, and why every tool the Fed has left makes your position worse. Money velocity measures how many times a dollar changes hands in the real economy per year. It's simple math. GDP divided by money supply. If velocity is 2.0, each dollar in circulation generates $2 of economic activity. If velocity is 1.0, each dollar generates $1 of activity. The Fed's own data shows M2 velocity collapsed from 2.2 in 1997 to 1.1 in 2024. Money is moving half as fast. Here's why that matters. When velocity drops, each new dollar the Fed prints has less economic impact. They need to print more dollars to achieve the same effect, which drives velocity lower, which requires more printing. It's a debt spiral disguised as monetary policy. The standard explanation blames low interest rates, demographic aging, and corporate hoarding. People aren't spending, banks aren't lending, money sits idle. That explanation is incomplete. Aggregate velocity, the number everyone watches, hides two completely different systems operating simultaneously. One system where money barely moves, another where money moves so fast it's invisible. The Fed didn't accidentally create this split. They engineered it. Here's the mechanism. When the Fed creates new money through quantitative easing, that money doesn't enter the economy evenly. It flows through specific channels to specific institutions with specific privileges. Primary dealers, repo markets, excess reserve accounts, supplementary leverage ratio exemptions. These aren't obscure technical details. They're the infrastructure of the two-speed system. The money that reaches you, wages, stimulus checks, small business loans, moves through the economy once, maybe twice, then stops. You spend it on rent. The landlord pays the mortgage. The bank holds the payment. Velocity 1.1. The money that reaches financial institutions, QE purchases, overnight repos, corporate credit facilities, moves through leveraged trades, derivative chains, and high-frequency algorithms. It turns over 15, 20, 40 times before you've spent your paycheck once. Same currency, different velocity, by design. The aggregate number, 1.1, is an average that conceals the split. It's like averaging the temperature of ice and boiling water, and concluding the system is room temperature. It's not room temperature. Half the system is frozen, the other half is accelerating toward a phase change, and the gap is widening every quarter. When velocity falls, the economy needs more money to function. The Fed prints, but that new money doesn't flow evenly. It flows through the high-velocity channels first. Asset prices rise, wealth concentrates, wage earners fall further behind. The system isn't broken, it's working exactly as designed. Let's look at how this exact pattern played out before. The historical blueprint, Rome's two-speed collapse. Rome ran this exact playbook 1,800 years ago, stage by stage. The same mechanism, the same outcome. Stage 1, 64 AD. Nero needs money for wars and public works. He debases the denarius, drops the silver content from 100% to 90%. The currency still functions. Velocity stays high in the provinces. Merchants accept the coins. Trade continues. Stage 2, 193 to 235 AD. The Severan dynasty accelerates the debasement. The denarius drops to 50% silver. Now merchants notice. They start hoarding the older, heavier coins. Gresham's law kicks in. Bad money drives out good. Provincial trade slows. Velocity begins to fragment. Stage 3, the crisis of the 3rd century. The denarius collapses to 5% silver. It's basically copper with a silver wash. And here's where the two-speed system emerges. Patricians, the senatorial class, large landowners, military commanders, stop using the denarius entirely. They trade in gold solidi, they exchange land deeds, they move wealth through networks of personal obligation and tribute. Their velocity stays high. Gold changes hands rapidly, land transfers quickly. The elite economy functions at full speed. The plebeians, wage laborers, small merchants, soldiers, paid in debased coin, are trapped in the dying currency. They're legally required to accept the denarius. Their wages are denominated in it, their debts are collected in it, but no one with real wealth will take it. Wage velocity collapses. A soldier's pay buys less each month. A farmer can't sell grain for coin that merchants won't accept. The low-velocity system seizes. Two currencies, two classes, two speeds. The mechanism is identical to today. The central authority maintains asset velocity for the elite through alternative stores of value, while wage earners are locked into the collapsing currency. The Roman state keeps minting denarii and demanding taxes in denarii. But the wealthy pay in kind, grain, goods, land rights, or they pay in gold at artificially favorable exchange rates. The poor pay in coin that's worth less every year. Stage 4, 284 AD. Diocletian takes power. The denarius is worthless. He tries price controls. He tries currency reform. He tries splitting the empire into manageable pieces. None of it works. The two-speed system has already extracted maximum value. The elite have converted to hard assets. The masses are destitute. The empire doesn't collapse in a single dramatic moment. It fragments. The high-velocity system becomes feudalism, localized, asset-based, with velocity contained within aristocratic networks. The low-velocity system becomes serfdom, populations tied to land, paid in kind, with monetary velocity approaching zero. Rome took 220 years to run through all four stages. The Fed has been running the same playbook for 16 years. And they're accelerating. The debasement is faster. The velocity split is sharper. The control mechanisms are more sophisticated, but the pattern is identical. When you create a two-speed money system, the high-velocity class extracts wealth until the low-velocity system collapses. Then they exit into hard assets while the masses are left holding worthless claims. Rome proved the math. Diocletian couldn't stop it. Neither can Jerome Powell. Now let's look at exactly how the Fed engineered the modern version. The mechanism, how the Fed engineered the split 2008. The financial crisis hits. Lehman Brothers collapses. The Fed responds with the largest monetary intervention in history. And they build the infrastructure for the two-speed system in the process. First move, interest on excess reserves, IOER. Before 2008, banks couldn't earn interest on reserves parked at the Fed. If they had excess cash, they had to lend it out or accept zero return. After 2008, the Fed starts paying interest on reserves. Banks can now park money at the Fed and earn risk-free returns without lending to businesses or consumers. The result, $3.3 trillion in excess reserves sitting idle at the Fed while M2 velocity collapses. The money exists. It's just not moving through the wage economy. It's locked in the high-velocity system, earning guaranteed returns for institutions that don't need to take lending risk. Second move, quantitative easing, QE. The Fed creates new money and uses it to buy assets. Mortgage-backed securities, treasury bonds, agency debt. Who sells those assets to the Fed? Primary dealers, the 24 financial institutions with direct access to Fed operations. The new money flows into their accounts first. They use it to buy more assets, stock buybacks, corporate bonds, real estate portfolios. The money never touches the wage economy. It goes straight into asset markets. The data proves it. S&P 500 up 400% from 2009 to 2021. Real median wages flat. That's not a coincidence. That's velocity divergence by design. Third move, corporate buybacks funded by Fed credit. From 2010 to 2020, corporations spent $5.3 trillion buying back their own stock. They didn't raise wages. They didn't increase capital expenditure. They didn't hire more workers. They borrowed money at near zero rates, rates made possible by Fed policy, and used it to reduce share count and boost stock prices. Each buyback accelerates asset velocity. The same shares trade hands faster. The same dollars circulate through fewer hands at higher speed. Meanwhile, production investment stagnates. Wage velocity continues to fall. Fourth move, the supplementary leverage ratio exemption, 2020. Banks are required to hold capital against their assets. The SLR sets the minimum ratio. In 2020, the Fed exempts treasuries and reserves from the SLR calculation. Banks can now hold unlimited government debt without tying up capital. This creates infinite velocity for government borrowing. The Treasury issues debt. Primary dealers buy it. The Fed buys it from the dealers. The dealers buy more. The cycle repeats. The government borrows at light speed. You repay through taxes collected at wage velocity. The gap widens with every cycle. Fifth move, the repo market. $4 trillion daily. Repurchase agreements, repos, are overnight loans between financial institutions. One bank sells securities to another and agrees to buy them back the next day. It's invisible to the public, but it's the highest velocity market in the system. The same treasury bond can move through 10 different institutions in a single week. Each transaction generates fees. Each turn accelerates velocity. The repo market is the engine of the high velocity system. It's where new Fed money multiplies before it ever reaches the real economy. And when the repo market seizes, like it did in September 2019, the Fed intervenes immediately with hundreds of billions in liquidity. When wage earners can't pay rent, there's no immediate intervention. When primary dealers can't roll overnight repos, the Fed opens the floodgates within hours. That tells you which system matters. This isn't theory. The mechanisms are documented, the facilities are public, the data is available. The Fed engineered a monetary system where money for wages moves once and stops, while money for assets moves 40 times through leverage, buybacks, and overnight markets. Same central bank, same currency, two completely different velocities, and the split is measurable in the actual data. The data, measuring the two velocities. Let's measure the two speeds directly. Wage velocity. Take M2 money supply and divide it by total wage income. How many times does $1 of wages turn over in the economy per year? 1997, 2.8 times per year. 2024, 1.5 times per year. That's a 45% collapse in wage velocity over 27 years. Now measure asset velocity. Take the total value of financial assets, stocks, bonds, derivatives, and divide by the trading volume in those markets. 1997, 8 times per year. 2024, 34 times per year. Asset velocity increased 320%, while wage velocity collapsed 45%. Same time period, same central bank, same dollar. Two completely different systems. Here's what that looks like in practice. 2020, the pandemic hits. The government sends $1,400 stimulus checks to 160 million Americans. That's $224 billion. Where does that money go? Rent, groceries, utility bills, debt payments. Each dollar moves once, maybe twice if the landlord pays their mortgage and the bank credits the servicer. Velocity, 1.1, same year. The Fed launches $4 trillion in quantitative easing and emergency credit facilities. Where does that money go? Asset purchases, corporate bonds, mortgage-backed securities, stock buybacks. Each dollar moves through leveraged trades. A hedge fund borrows against treasury collateral at 10-to-1 leverage, buys corporate bonds, sells them to another institution. That institution repos them overnight. The cycle repeats. Velocity, 15 to 40 times per year depending on the asset class. The $1,400 checks moved $224 billion through the economy once. The $4 trillion in Fed facilities moved $60 trillion to $160 trillion through financial markets in the same period. That's the velocity gap in action. And here's the wealth transfer that results. From 2009 to 2024, total U.S. wealth increased by $50 trillion. 90% of that increase went to the top 10% of households. Not because they worked harder, not because they were smarter, because they had access to the high velocity system. If you own assets, stocks, real estate, bonds, your wealth compounds at the speed of asset velocity. Your portfolio turns over 20 times per year through appreciation, dividends, and trading gains. If you earn wages, your wealth accumulates at the speed of wage velocity. Your paycheck turns over 1.1 times per year. The mathematical result is inevitable. Wealth concentrates in the high velocity system. And here's why consumer price inflation stays low, despite $8 trillion in money printing. The high velocity money never enters consumer goods markets. It circulates in assets, stocks, bonds, real estate, derivatives. $1 billion moving through the repo market 40 times doesn't buy groceries. It doesn't bid up the price of cars or rent, at least not directly. It bids up the price of the assets that produce those goods, which eventually raises prices. But the velocity gap means the inflation shows up in asset prices first and consumer prices later. By the time you see 8% CPI, asset holders have already captured 40% returns. They front-run your inflation because their money moves faster. The two-speed system isn't just unfair, it's mathematically extractive. Every dollar the Fed prints accelerates the velocity gap. Every quarter, the high velocity system pulls further ahead. And the pattern says this two-speed structure isn't sustainable. History shows what comes next. The endgame, why the trap, closes. The two-speed system has a mathematical endpoint, and we're accelerating toward it. Here's the inevitability. As wage velocity falls, the economy generates less GDP per dollar in circulation. The Fed needs to print more money to hit the same growth targets. But that new money flows through the high velocity channels first. Asset prices rise, the wealth gap widens, wage earners fall further behind, which drops wage velocity even lower, which requires more printing, which accelerates asset velocity faster. It's not a policy choice at this point, it's a debt spiral with only one exit. The government is now borrowing at high velocity to sustain an economy that operates at low velocity. Treasury issues bonds. Primary dealers buy them in milliseconds. The Fed absorbs them through QE or repo facilities. The dealers buy more. The debt turns over 40 times per year in financial markets. But that debt is repaid through taxes. Taxes on wages, taxes collected at 1.1 velocity. The gap is exponential. Every year, the government borrows faster than the tax base can possibly repay. Federal debt hit $36 trillion in 2024. It's growing by $1 trillion every 100 days. That's not sustainable at wage velocity. The only way to service that debt is to keep the high-velocity system running at maximum speed, which means more printing, more QE, more repo facilities, more SLR exemptions, which widens the velocity gap further. We've seen this pattern before. Weimar Germany, 1921 to 1923. The Weimar Republic borrowed in gold-backed marks to pay war reparations. They printed paper marks to fund the government. Workers were paid daily because wage velocity collapsed so fast that monthly paychecks were worthless by the end of the month. But industrialists and bankers moved capital into foreign assets at hypervelocity. They converted marks to dollars, Swiss francs, and British pounds the moment they received them. Two speeds, two outcomes. The workers held currency that lost 50% of its value every week. The elite held assets that appreciated in real terms as the mark collapsed. By 1923, the currency was worthless. The low-velocity system seized completely. Bank runs, riots, political collapse. The high-velocity system exited into hard assets and foreign accounts before the freeze. That's the control mechanism. The two-speed system allows the elite to extract maximum value before collapse because they can exit at high velocity while the masses are trapped at low velocity. You can't escape the trap if you're paid in wages. Here's why. To access the high-velocity system, you need capital. Enough capital to buy assets that appreciate faster than wages. Enough capital to leverage. Enough capital to trade with institutional velocity. But you can't accumulate that capital at low velocity. Your wages turn over 1.1 times per year. By the time you save enough to buy appreciating assets, those assets have already doubled in price because they're moving at 34 times per year. You're always behind, mathematically, structurally. The system is designed so that wage earners cannot catch up. The velocity gap prevents accumulation. And when the trap closes, when the low-velocity system finally seizes, you're still holding the collapsing currency while the high-velocity class has already converted to hard assets. The pattern says every empire that engineered this split collapsed within one generation of creating it. Rome, 50 years from Nero's debasement to the crisis of the 3rd century. Weimar, 3 years from the start of hyperinflation to total collapse. The Soviet Union, 20 years from the creation of the two-tier ruble system to the 1991 dissolution. The timeline varies. The mechanism is identical. Create a two-speed money system. Extract wealth through the velocity gap. Exit into hard assets when the low-velocity system seizes. The Fed engineered this system in 2008. We're at year 16. The math says the trap is already closing. Where we are in the pattern and what it means. Let's run the stage check. Velocity split confirmed. M2 velocity at 1.1, the lowest in recorded history. Asset velocity at 34 times per year, the highest ever measured. Check. Asset inflation confirmed. S&P 500 at all-time highs despite declining corporate revenues. Real estate, 47% above pre-2008 levels adjusted for wages. Bond markets trading at velocities that require continuous Fed intervention. Check. Debt spiral confirmed. Federal debt at $36 trillion, growing $1 trillion every 100 days. Debt to GDP at 124%, higher than any point except World War II. Check. Political instability rising, trust in institutions collapsing, wealth inequality at Gilded Age levels, the social contract fraying as the velocity gap becomes visible to the population. Check. We're not heading toward the pattern, we're in it. The 2024 data shows exactly where we are, deep into stage 3 with stage 4 mechanisms already being deployed. The Fed has two options left. Continue printing to keep the high-velocity system liquid, or stop printing and watch the high-velocity system crash. They'll choose printing, every time, because the people who control the high-velocity system, primary dealers, institutional asset managers, the top 1% of wealth holders, have direct access to the Fed. They have leverage. They have political power. The low-velocity population has none of that. Wage earners can't demand emergency repo facilities. They can't call the Fed chair and request SLR exemptions. When the high-velocity system needs liquidity, it gets liquidity within hours. When the low-velocity system needs relief, it gets hearings and committees and delayed payments. That tells you which system the Fed will protect. The timeline is measurable. Rome took 50 years after the velocity split became structural. Weimar took 3 years after hyperinflation began. The Soviet Union took 20 years after the two-tier ruble system was formalized. The Fed engineered the modern two-speed system in 2008. We're at year 16. Based on historical velocity patterns, the two-speed system typically lasts 15 to 25 years before the low-velocity system seizes. We're in the window. What does collapse look like? Not a sudden crash, Not a single day when everything stops. It's a freezing of the low velocity system while the high velocity system converts to hard assets and exits. Bank holidays, capital controls, currency restrictions, limits on withdrawals and transfers. The low velocity population wakes up one morning and discovers their money doesn't move anymore. Meanwhile, the high velocity class has already converted. Real estate, gold, foreign accounts, offshore trusts, hard assets that hold value when currency velocity hits zero. They're not escaping the collapse. They're front-running it at 40 times your speed. The math says we're not approaching this endgame. We're already in it. The velocity gap is wider than any point in modern history. The debt is growing faster than the tax base can service. The Fed is trapped between crashing the system or printing until the currency fails. And every quarter, your position gets worse while theirs gets stronger. The pattern doesn't lie. The math doesn't lie. We're next. The truth in the pattern. The velocity trap is the mechanism by which the Fed ensures the elite can exit at full speed while you're locked in at stall speed. It's not an accident. It's the final stage of centralized control before implosion. Rome took 50 years after the two-speed system formed. Weimar took 3. The Soviet Union took 20. We're at year 16. If this opened your eyes to where we actually are in the sequence, subscribe to Financial Rewinds, because when we hit the final stage and the low-velocity system freezes, you'll want to understand what happened, why it was inevitable, and what the pattern says comes next. The answers aren't hiding in the future. They're written in the past. And the math says we're already locked in.